Okay, so you send over a copy of High Probability ETF Trading. It's by Larry Connors, right?
Sure.
And Cesar Alvarez.
Yeah.
And you said you're looking for strategies strategies that are built on some good data,
Mhm.
not just, hype.
Exactly. And that's what I think is really interesting about this book. It really digs into these strategies that have a history of success.
Okay, so let's start with the author, Larry Connors, pretty big name in the trading world.
hmm
Um, what's his background? What's he all about?
Well, Connors is known for his quantitative approach to trading. So he's not about following the crowd or making emotional decisions, really. He focuses on finding these statistical edges that can give you an advantage in the market. In fact, he actually developed a trading strategy called the Connors RSI, which is very widely used by professional traders.
Wow, Connors RSI.
Okay.
Okay, so he's all about data strategy, and this book seems to be a reflection of that.
Absolutely. And I think it's worth mentioning that Connors has also written several other really influential books on trading, like Short-Term Trading Strategies That Work, which he co-authored with Cesar Alvarez.
So this isn't their first rodeo together.
Not at all.
Okay.
Alvarez may not be as well known as Connors, but he's a respected trading expert in his own right. He's been working with Connors for years, and he's deeply involved in their research and trading strategies.
Okay. So we've got two experienced, data-driven traders behind this book. What's the big idea they're trying to get across here?
Well, the book centers around this idea of high probability ETF trading. Basically, they're arguing that you can find and use strategies that have historically won at least 65% of the time when trading ETFs.
Okay, so not just any random strategy, but the ones that actually have a track record
Right.
of working.
Yeah.
Okay.
It's all about tilting those odds in your favor. Now, a big part of their approach focuses on identifying ETFs that are in a prime location. Think of it like real estate. Location, location, location. It's everything.
So you want to be in the right ETF at the right time.
Exactly. And they argue that ETFs tend to react to overbought and oversold conditions more predictably than individual stocks, making them ideal for these types of strategy.
And they actually use the events of 9/11
Oh, yeah.
as an example of how these ETFs recovered more predictably than individual stocks.
Exactly. In times of high market volatility, ETFs tend to kind of demonstrate a more stable and predictable recovery pattern.
Interesting. But before we jump into the strategies, let's talk about what they don't cover.
Right.
Um,
It's important to note that Connors and Alvarez specifically state that they did not include leveraged or inverse ETFs in the data they'll be covering. They acknowledge that these types of ETFs trade very differently
okay,
from traditional ETFs.
gotcha. So we're focusing on the traditional ETFs here.
Right.
Now, the book's broken down into these chapters, each one focusing on a different high probability strategy. So are you ready to unpack some of these?
Absolutely. Let's dive in. Chapter 2 is all about the 3-day high-low method. It's a pretty straightforward strategy where you're looking for ETFs that are making lower highs and lower lows over 3 consecutive days.
Okay, so lower highs, lower lows for 3 days. Sounds simple enough, but how effective is it?
Well, that's the impressive part. They tested this method across 20 popular ETFs and found a win rate of over 76% for the basic version of the strategy. And for the aggressive version, the win rate jumped to over 82%.
Whoa, okay. Those are some pretty compelling numbers. So walk me through an example, how does this actually work in practice?
Okay, so let's say you're looking at the iShares MSCI Emerging Markets Index ETF, ticker symbol EEM. And you see that EEM has been making, those lower highs, lower lows for 3 straight days.
Okay,
And importantly, it's trading above its 200-day moving average.
gotcha.
That setup, according to the basic 3-day high-low method, would actually generate a buy signal.
Okay, so it's a combination of the 3-day pattern
Yeah.
and where it is relative to that 200-day moving average.
Yeah. Exactly.
Okay.
Now, the aggressive version of this strategy takes it a step further. Let's look at the iShares MSCI Brazil Index ETF, ticker symbol EWZ. With the aggressive approach, you would actually add to your position on the second day if the price closes lower than your initial entry price.
Oh, so you're doubling down on the fact that you think it's going to reverse.
Essentially, yes. This scaling in approach can magnify gains, but it also increases your risk.
Of course, makes sense. High reward, higher risk.
Exactly. Now, Chapter 3 introduces another really popular indicator, the Relative Strength Index, or RSI. And this chapter focuses on the RSI 25 and RSI 75 strategy.
Okay. I've heard of RSI. It's like a momentum indicator, right?
Right. But what's interesting here is that Connors and Alvarez specifically use the 4-period RSI,
Hmm.
which is much shorter than, the typical 14-period RSI setting.
Okay.
This makes the strategy more sensitive to like short-term price swings.
It makes sense given their focus on short-term trading strategies.
Right.
So how do they use the RSI to identify trading opportunities?
They look for ETFs that are either overbought or oversold. So if the 4-period RSI dips below 25, it signals an oversold condition and a potential buy. Conversely, if it climbs above 75, it signals an overbought condition and a potential short.
And the exit is when it crosses back over the 5-day moving average, just like the other strategy.
You got it. Now, let's talk results. On the long side, the strategy boasts a win rate exceeding 76% for both the basic and aggressive versions. But here's the kicker. The short side has an even higher success rate, over 68% for the basic and a whopping 75% for the aggressive.
Wow. That's a big difference.
It is.
I wonder why the short side is so much more successful. Maybe we can come back to that.
Definitely.
But for now, let's look at what's an example of a trade.
Okay, so for the basic, long side trade, they use the iShares Latin America 40 Index, ticker symbol ILF. When the 4-period RSI for ILF dipped below 25, it triggered a buy signal. And just like the 3-day high-low method, the exit signal is when the ETF crosses back above its 5-day moving average.
Okay. I see. And then what about, the aggressive RSI strategy?
Okay. To illustrate that, they use the iShares Fosexen China 25 Index ETF, ticker symbol FXI. With the aggressive approach, you're basically scaling into your position as the price moves in your favor. So if the price continues to drop after you buy, you'd actually add to your position.
So again, amplifying potential gains,
Yeah.
but also amplifying your risk.
Exactly. Now, Chapter 4 unveils another really intriguing approach, the R3 strategy. This one uses the 2-period RSI, which is even shorter term than the 4-period RSI.
Whoa. A 2-period RSI, that's getting really granular.
It is, and it makes the strategy even more sensitive to, these quick reversals.
Oh, so you're really looking for sharp changes in direction.
Precisely. Now, the R3 strategy focuses on a specific 3-day drop pattern in the RSI, and the results are consistently impressive, with win rates often above 80% for both long and short trades.
Okay, so can you, break down an R3 trade for me?
Sure. Let's stick with ILF, the iShares Latin America 40 Index. Picture this. The 2-period RSI drops below 10 for 3 consecutive days, and the first day's drop started from above 60. That setup would trigger a buy signal according to the basic R3 strategy.
Okay, so it's not just that it's below a certain level, but it's also the fact that it dropped.
You're catching on. Now, for the aggressive R3 approach, they use EWZ,
Okay.
the iShares MSCI Brazil Index ETF again. And similar to the other aggressive strategies, you'd add to your position as the price continues to decline.
So again, that scaling in approach.
That's right. And as we've discussed, that amplifies both the potential reward and the potential risk.
Right, it's all about finding that balance.
Absolutely. Now, Chapter 5 takes us into the world of Bollinger Bands and the Perceived strategy.
Okay. Bollinger Bands, I've heard of those. They're those lines that kind of envelop the price action, right?
That's right. They essentially act as these dynamic support and resistance levels that adjust to the market's volatility. Now, the Perceived indicator, it measures an asset's position within its Bollinger Bands. So it basically tells you how overbought or oversold an asset is relative to its recent price range.
Gotcha. So if the perceived is really high, it suggests the asset's overbought. If it's really low, it suggests it's oversold.
Exactly. And the strategy rules are surprisingly simple. You buy when the perceived is below 0.2 for 3 consecutive days, and you short when it's above 0.8 for 3 consecutive days.
Okay. Simple and straightforward. So how accurate is this strategy?
It boasts impressive accuracy, with the basic version exceeding 75% and the aggressive version surpassing 80% correct signals.
Wow, those are some pretty high numbers. Can you walk me through a perceived trade?
Sure. For a basic perceived long trade, let's look at GLD, the SPDR Gold Trust. Okay, so imagine that GLD has closed below its 200-day moving average for 3 consecutive days, and its perceived reading is also below 0.2 for those same 3 days. This combination would trigger a buy according to the perceived strategy.
And then the exit is when it closes back above its 5-day moving average.
Right. It's similar to the previous strategies in that sense.
Okay.
Now, for the aggressive per B trade, they use ILF, the iShares Latin America 40 Index. And in this scenario, ILF drops below its 200-day moving average, and its per 5 falls below 0.2. But here's where the aggressive approach comes into play. You would add to your position as the price continues to decline.
Okay, so that scaling in approach.
Mm-hmm.
It's interesting how they apply that to so many of
Yeah.
these strategies.
It's a consistent theme
Yeah.
throughout the book. They believe that scaling in, when done strategically, can really amplify gains.
Okay. We've covered a lot of ground already.
I know.
Let's take a quick pause here and then dive into the remaining strategies in part 2 of our deep dive.
Sounds good to me.
All right.
There's plenty more to unpack.
Okay. All right. So we've already covered like 4 of the high probability ETF trading strategies from Connors and Alvarez. Ready to tackle a few more.
Absolutely. I'm eager to see what other insights they have in here.
Okay. So let's jump into chapter 6. This one introduces the multiple days up MDU
Right.
and multiple days down MDD strategy.
Yeah, this one plays on like the concept of mean reversion, that prices tend to kind of like revert back to their average over time.
So if an ETF has been moving significantly in one direction for several days,
Right.
it's likely to kind of like turn around.
Exactly. And this strategy specifically uses the 200-day moving average as like the reference point.
Okay.
So an MDU pattern means like the ETF has closed higher than its 200-day moving average for multiple days in a row.
So you'd want to short that.
Right, because it's likely overbought.
Okay.
And conversely, an MDD pattern means that ETF has closed lower than its 200-day moving average for multiple days in a row, suggesting it's oversold and a potential buy.
Okay, so this seems like a relatively simple strategy to implement. Like you're just basically looking for these ETFs that have moved like significantly away from their 200-day moving average.
Yeah.
And then betting on a reversal. How do you figure out like what the number of days should be? Like what's Connors and Alvarez, they mostly use 4 or 5 days.
Yeah, that's a great question. And they do mention that, the optimal number of days might actually vary depending on, the specific ETF that you're trading, the overall market conditions, your own personal trading style. So there's not really a one-size-fits-all approach here.
Right. So some testing
Yeah.
and observing is necessary.
Yeah.
Okay. So how did the MDU, MDD strategy perform, compared to some of these others?
Well, according to their research, this strategy delivered consistent profitability with win rates often exceeding 70% across both the basic and aggressive versions.
So pretty solid, especially considering its relative, simplicity.
Right.
Could you walk me through an example?
Sure. So let's look at the Energy Select Sector SPDR ETF, ticker symbol XLE. They actually highlight a period where XLE had 4 lower closes relative to its 200-day moving average. This triggered a buy signal, and the very next day, XLE reversed sharply upward, confirming the strategy.
Interesting. So they were able to catch a nice reversal.
Right. And to illustrate the aggressive MDD approach, they use the iShares MSCI EAAEE Index Fund ETF, ticker symbol EF. And in this case, EFA also had 4 lower closes relative to its 200-day moving average. But, this time, instead of just entering one position, the aggressive version suggests adding to the position as the price continues to decline.
Oh, so that scaling in approach.
Exactly. Always aiming to kind of maximize those gains when you have conviction in the setup.
Right. And as always, manage your risk carefully, especially when you're using aggressive strategies.
Absolutely.
All right, let's move on to chapter 7. This seems like kind of a shorter chapter. It focuses on the RSI 106 and RSI 9094 strategy, which I'm assuming is, involving some pretty extreme RSI readings.
Yeah, you got it. We're back to the 2-period RSI. So really focusing on those very short-term price fluctuations. This strategy is all about catching those quick reversals based on those extreme RSI readings. So either very low or very high.
So if the RSI dips below 10 or spikes above 90, it's signaling a potential trade.
Yeah, essentially, yes. They argue that these extreme readings often precede those sharp reversals.
Okay, so kind of similar to the R3 strategy in that it's targeting those really quick moves.
Exactly.
Okay, how does this one perform compared to the others?
Well, the results are pretty interesting here. While the long side results were mixed, they point out that every single ETF they tested actually showed a net profit on the short side using the strategy.
Wow. Every single one.
Every single one.
Okay, so that definitely says something.
Yeah.
Okay, so for they use a short RSI 9094 trade. They use IWM, the iShares Russell 2000 index.
Yeah, and they show how a 2-period RSI reading above 90 followed by a close above 94 would generate that short signal. And the exit, as usual, is when IWM closes back below its 5-day moving average.
Okay, so pretty clear-cut signals there. What about like an example of the aggressive RSI 106-9094 strategy?
Okay, for that, they use EWJ, the iShares MSCI Japan Index ETF.
Okay.
And they show EWJ closing above its 200-day moving average with the 2-period RSI reading above 90, followed by another close above 94. And now the aggressive element kicks in. You scale into that position as the price moves higher.
So shorting more as it gets potentially even more overbought.
Interesting, yeah. You know, it seems like a lot of these strategies are kind of based on that same principle, like identifying those points where the market's likely to reverse and then capitalizing on that.
Right.
And they seem to have like a fondness for that scaling in approach.
They do.
And they really like make a compelling case for it. They believe that scaling in, when done strategically, can really amplify gains.
Right.
And improve overall performance.
Okay. Let's move on to Chapter 8. This one, I have to admit, sounds a little bit mysterious. It's titled An Introduction to TPS.
Okay, so this is where things get really interesting. TPS stands for Time, Price, Scale In. This is actually a proprietary strategy that Connors developed.
Okay.
And initially kept, like, pretty under wraps, only sharing it with members of his, like, exclusive high-level trading group called the Chairman's Club.
Whoa, okay. Fancy. So what's the secret sauce behind TPS? What makes it so special?
Well, the core principles of TPS involve, like, combining time, price, and scaling in to pinpoint those optimal entry and exit points.
Okay.
So time refers to the number of days that ETF has been in a certain condition relative to its moving averages.
Okay.
Price refers to the ETF's current price in relation to its moving averages. And then, of course, scale in refers to their favorite approach of, like, strategically adding to position.
Right, right. So it's like a little bit more nuanced and multifaceted than these other ones.
Exactly. It's like they took all of the best elements from like the previous strategies and they kind of like weaved them together into this like more sophisticated system.
Okay. So what kind of results did they see?
Okay, so with TPS, they actually observed win rates of over 88% on long trades and over 80% on short trades across a range of ETFs.
Oh, wow. Those are some really high numbers.
Yeah.
It makes sense that he was keeping that one secret. Okay, so can you like break down a TPS trade for me?
Okay, sure. So let's use EWZ, the iShares MSCI Brazil Index ETF, to illustrate the full, like 100% scaling in approach on the long side.
Okay.
So picture this. EWZ has been trading below its 200-day moving average, and its 2-period RSI is below 25 for 2 consecutive days. This would trigger the first entry.
Okay, so kind of like similar setup to some of the others we've discussed.
Right. But here's where that scaling in comes into play. As the price of EWZ continues to decline, you know, additional positions are added at like these predetermined price levels. And this continues until, you know, that full position size is reached.
So you're kind of like averaging into it.
You got it.
As it goes down.
Okay.
And then the exit is triggered when that 2-period RSI crosses back above a certain level, showing that, you know, it's reversed that oversold condition.
Exactly. Now, on the short side, they actually provide 2 examples.
Okay.
The first one uses SPY, the SPDR S&P 500 ETF.
Okay.
And they show like a scenario where SPY is trading below its 200-day moving average, and the 2-period RSI is above 75 for 2 consecutive days.
Okay.
This would trigger that first, like, short entry.
So looking for an overbought condition to short it.
You got it. And then just like on the long side, the scaling in would begin as the price moves higher.
So shorting more as it goes up, potentially.
Exactly. You know, the goal is to capitalize on the potential for, like, a more significant decline.
Right. It's interesting how they're combining, like, these different elements, like the time, the price, and then the scaling in to create this, like, sophisticated and high-performing trading system.
Yeah, it really highlights the importance of taking like a holistic approach to trading.
Right.
And considering like multiple factors.
Right, not just like one indicator, but like
exactly
all these different pieces of information.
Yeah, it's like they're putting together a puzzle, you know, with each piece representing like a different aspect of market analysis.
Right. And then their second like short TPS example uses DIA.
Yes.
The Diamonds Trust Series 1 ETF.
Exactly. And that reinforces the scaling in approach and like highlights those entry and exit points as the price of DIA moves higher.
Right. So it's all about like identifying those points where the market is likely to make a significant move,
Right.
and then strategically scaling in as the move unfolds.
You nailed it. And as their results demonstrate, this strategy can be incredibly powerful when executed properly. But I think it's also really important to emphasize that, TPS, like all trading strategies, is not a magic bullet. There will always be losing trades, and it's essential to manage your risk effectively.
Right. No strategy is going to guarantee profit.
Exactly. Trading is about probabilities, not certainties.
Right.
Yeah.
Now, Chapter 9 takes a bit of a different approach. It's titled Think Deeper.
Yeah.
And it seems to be more about kind of like the psychological side of trading.
Yes, exactly. This chapter really shifts the focus from the specific strategies to more like the broader principles of mastering ETF trading.
Right.
So it's about developing the right mindset and the skills to really become a successful trader.
So like going beyond just the technical aspects of trading.
Absolutely.
Okay.
They draw a parallel to The Talent Code by Daniel Coyle, which explores how exceptional performers in various fields achieve mastery. And they argue that, those same principles of deliberate practice and deep thinking apply to trading.
Interesting. So it's not just about like following a set of rules, but really like understanding the market and your own trading behavior.
Yeah. It's about going beyond simply following a recipe and developing that ability to think critically, analyze information, adapt to changing conditions.
Right. So how do they suggest traders, think deeper?
Well, they emphasize the importance of breaking down those complex trading strategies into smaller, more manageable chunks. It's about dissecting the strategy, understanding the logic behind it, identifying the key elements that drive its success.
So really understanding the why behind it.
Exactly. And, they also stress the importance of analyzing your trades closely, both the winners and the losers.
Right.
So learning from, your successes and your mistakes.
Of course. Yeah.
Right. By carefully reviewing your trades, observing patterns, and, identifying areas for improvement, you can actually develop a deeper understanding of, your own trading strengths and weaknesses.
Right. And then that self-awareness can then lead to better decision-making and performance.
Exactly. And they actually advocate for keeping a detailed trading journal, recording the entry and exit points. Profit loss, any other relevant observations for each trade.
So a trading journal can be a good tool.
Yeah, absolutely.
Okay. So thinking deeper is about continuous learning, self-reflection, and really a deeper understanding of the market.
Exactly. It's about becoming a student of the market and constantly seeking those ways to improve your skills and knowledge.
Okay, that makes sense. Now, Chapter 10 seems like kind of wrapping everything up, put a nice little bow on things. It's titled Putting the High Probability ETF Trading Pieces Together.
Yeah, this chapter serves as a really good reminder of those key lessons learned throughout the book. And it provides some really practical guidance on applying these principles in real-world trading. So it's about taking all those pieces of the puzzle and assembling them into a comprehensive trading approach.
So they reiterate the importance of, that 200-day moving average.
Yeah.
The power of the short-term trading strategies, the discipline, risk management.
Absolutely. And they also remind readers about that, correlation risk that we talked about, encouraging them to really diversify their holdings across different sectors and asset classes to kind of mitigate that risk.
You don't want to be...
Yeah, you don't want to be overly exposed
super concentrated
to a single sector or asset class.
Right. Diversification is key.
Exactly.
And they offer some practical tips on finding the right ETF to trade backtesting strategies.
Yeah.
Executing trades effectively.
Yeah. It's a little cheat sheet for putting all these concepts into action.
Yeah. Okay. So we've covered a lot of ground today.
I know.
7 high-probability ETF trading strategies. Tips for thinking deeper.
Yeah.
Some key insights on risk management.
It's been a fantastic journey through the world of data-driven ETF trading.
It has. But I think we should circle back to something we talked about earlier. The fact that Connors and Alvarez specifically excluded leveraged and inverse ETFs from their testing.
Oh, yeah. That's right.
So it raises a big question for me. Can these strategies be adapted for leveraged or inverse ETFs?
It's certainly possible, but it would require like really careful consideration and probably some adjustments. Leveraged in inverse ETFs, they amplify both gains and losses.
Right.
So risk management becomes even more critical.
I would imagine so. And even like the timing might need to be adjusted too, right? Because those tend to be a lot more volatile, so maybe you don't hold them as long.
That's a really good point. The entry and exit signals might also need to be fine-tuned to account for those, amplified price movements.
Right. Definitely not something to be taken lightly.
Absolutely. And as with like any trading strategy, thorough testing and risk management are absolutely paramount.
Right. Okay. Another thought I had was, this book was published back in 2009.
Right.
Are these strategies still relevant in today's market?
That's the million-dollar question, isn't it?
Yeah.
Markets are constantly evolving, and we've seen significant changes in the financial landscape since 2009.
Yeah.
The rise of algorithmic trading, the explosion of, new ETFs, increased volatility. They've definitely shifted the playing field.
So have these strategies stood the test of time?
I believe that the core principles behind these strategies are timeless. They're based on these, like, fundamental market dynamics, identifying overbought and oversold conditions, understanding trend behavior, and managing risk effectively. These concepts don't just, like, disappear.
Right. But the specific parameters and indicators they use might need to be adjusted.
Possibly, yes. And remember, they tested these strategies on a specific set of ETFs, mostly, like large cap, US-based funds. So the results might actually vary if you apply them to, other types of ETFs.
Like the sector-specific funds, international funds,
Exactly.
the leveraged inverse ETFs.
Yeah,
so it's you got to do your own research, back test the strategies.
Yeah.
Adapt as needed.
Absolutely. And as always, risk management is paramount. Never risk more than you can afford to lose. And always, protect your capital.
Right. Okay, so we're nearing the end of our deep dive here.
Yeah.
What are your final thoughts on, this book and its impact on traders?
I think, a high probability ETF trading is a really valuable resource for traders of all levels, especially, those who are looking for that data-driven, systematic approach. Connors and Alvarez have done a really excellent job of providing those, really clear, concise explanations of their strategies, backed by extensive research and, real-world examples.
And they really emphasize that, discipline, risk management, and continuous learning piece.
Absolutely. And I believe, this book can significantly improve trading results for anyone who's willing to put in the time and the effort to study these principles.
Right. Okay, well, this deep dive has given me a lot to think about.
I agree. It's been a very fascinating exploration of, those data-driven trading strategies.
Now, before we wrap up, I wanted to touch on one more thing that they mentioned, and that's ETF options.
Ah, yes, that's right. They do actually discuss how ETF options can be a really powerful tool for traders looking to either amplify returns or even hedge their positions. And they suggest that, the strategies outlined in the book can actually be applied to ETF options as well.
Right, but trading options involves a different set of risks and consideration.
Oh, absolutely.
Than just trading the underlying ETFs.
Yeah.
So it's important to really understand options trading before using these strategies.
Absolutely. And as always, thorough testing and risk management are absolutely essential.
Right. All right. So I think we've covered just about everything.
I think so.
We've taken a deep dive into high probability ETF trading.
Yes.
Explored these 7 powerful strategies. And then we even delved into the mindset and the skills that are needed to really succeed in this market.
Yeah. It's been a comprehensive and insightful exploration of a fascinating approach to trading.
Yeah. What are some, what do you think are, some key takeaways for our listeners?
I think one of the most important takeaways is that, data-driven trading can be a really powerful approach. By identifying and exploiting those statistical edges, traders can tilt those odds in their favor.
Right.
And improve their overall performance.
Right. So not relying on hunches or emotions,
yeah,
but actual data and analysis.
Yeah, exactly. And I think that's a really powerful message for any trader.
Okay, cool. And then another key takeaway, do you think, is the risk management piece?
Oh, absolutely. No matter, how good your strategy is, you need to manage that risk carefully.
Right.
And protect your capital.
Right, because trading is about probabilities.
Exactly.
Not certainties.
Yeah.
So there will be losing trades.
Right.
And you got to be prepared for that.
You got it.
And then finally, I think The book kind of underscores the importance of that, like continuous learning
Absolutely.
and self-reflection piece.
Yeah. The market is constantly evolving, and like those successful traders are always seeking to improve their skills and knowledge.
Right. Okay. Awesome. So you've been given seven, data-driven ETF strategies, insights from a master trader, even a challenge to think deeper
Yeah.
and elevate your trading game. What are you going to do with this knowledge? Remember, the real learning begins when you take these concepts and actually put them into action. Happy trading. Before we wrap up, I wanted to go back to Cesar Alvarez for a second. We've talked a lot about Larry Connors in this deep dive.
Yeah.
And, he's obviously a huge name in the trading world.
Yeah.
What about Alvarez? What's his story?
Yeah. So Alvarez may not be as well known as Connors, but he's definitely a seasoned trading expert in his own right. He's been working alongside Connors for years now, and he's super involved in all of their research and the trading side of things.
Okay, so he's not just like a silent partner on this book.
Right.
He's a legitimate trading expert.
Absolutely. And you can really see that expertise shine through in this book. They both have this clear passion for data-driven trading and for helping other people find success in the market.
Now, this book was published back in 2009, which feels like a lifetime ago in the world of finance.
It does.
Do you think these strategies are still relevant in today's market?
That's a great question. And honestly, it's one that every trader should be asking themselves. While markets are constantly evolving, kind of shifting and changing, the principles behind these strategies are timeless.
Okay, so the principles might be timeless, but have the strategies themselves stood the test of time?
Well, it's important to remember that they tested these strategies on a pretty specific set of ETFs, mostly large cap and US based. The results could be different if you apply them to other types of ETFs.
Like sector-specific funds,
Yeah,
international funds,
exactly.
even those leveraged and inverse ETFs we talked about.
Yep, those too. Those types of ETFs can behave very differently.
Okay, so it's important to do your research. Don't just blindly apply these strategies to any ETF you come across.
Exactly. And remember, manage your risk.
Right. Protect your capital. Well, I think we've explored just about every corner of high-probability ETF trading. We unpacked 7 powerful strategies, talked about thinking deeper, and even gained some valuable insights into risk management. What stands out to you as the most valuable takeaway from our deep dive?
For me, it's the emphasis on that data-driven approach to trading. Connors and Alvarez make a really strong argument for finding and exploiting statistical edges to, tilt those odds in your favor. They really push traders to think systematically and objectively about the market.
It's not about your gut feeling or your emotions.
Nope.
It's about probabilities and data and making decisions based on that.
Exactly. That's a powerful message for any trader.
Absolutely. Well, this deep dive has definitely given me a lot to think about, and I think it's safe to say that high-probability ETF trading offers valuable insights for traders at any level.
I agree. Whether you're a seasoned pro or just starting out, this book has something to offer.
So to wrap things up for everyone listening, remember that the real learning starts when you take these concepts and put them into practice. Test them, experiment, refine, and make them your own. Happy trading.